So you want to own a private jet charter company. You see luxury travelers boarding private jets, skipping commercial airport lines, avoiding crowds. They're flying on their own schedule. No security theater. No baggage fees. No delays. They're paying $8,000 to $15,000 per hour to fly on these jets. A 4-hour flight from New York to Miami generates $32,000 to $60,000 in revenue. A single aircraft doing 3 or 4 charters per week is generating $400,000 to $1.2 million in annual revenue. The business seems almost mathematically obvious. Buy a jet, find a charter company to market it, or build your own charter operation, and watch the revenue stream in. The jet works while you sleep. Customers pay up front. The operational costs seem manageable. You're selling access to something that costs money to operate anyway. It sounds like owning a luxury asset that pays for itself. It sounds like owning a charter company in 2015 when the market was booming, private aviation was expanding, and anyone with capital and a decent aircraft was making money. That is exactly the comparison people are making right now. Private aviation is absolutely massive. The private jet market is worth over $20 billion in annual revenue. There are over 10,000 registered private jets in the United States alone. Charter hours are booked years in advance at premium prices. Companies like NetJets and Flexjet are publicly traded and valued at billions of dollars. The ultra-wealthy are expanding faster than commercial travel is growing. Billionaires are buying jets. Corporations are increasing private aviation budgets. The demand seems endless and the margins seem enormous. But here's what is actually happening on the ground, inside charter operations when the cameras are off and the detailed financial statements are open. The reality of owning a private jet charter company is completely different from what the headline numbers suggest. Some charter operations are genuinely making money. Many are barely breaking even. And a significant number are losing substantial amounts annually. The gap between the three groups comes down to a handful of things that almost nobody explains before you spend $3 million to $80 million on an aircraft. By the end of this, you will know exactly where the money actually comes from, where it disappears to, what the hidden costs really are, and what separates the charter operations that thrive from the ones where owners are underwater on depreciating assets. What a private jet charter company actually sells. The perception versus reality. People assume that owning a jet charter company means you're selling flights. You are. But that's not where the money goes. If you're selling charter flights at standard market rates, the margins look impressive on a spreadsheet and evaporate in actual operations. What a private jet charter company actually sells is convenience, exclusivity, and flexibility. The ability to leave on your schedule. The assurance that you're traveling with people you choose. The guarantee that your flight will happen on your timeline. But here's the brutal truth. The customer doesn't value the jet. The customer values their time. They're willing to pay premium pricing for time convenience. But that time convenience is exactly what creates the operational nightmare for the charter company. Because accommodating customer scheduling flexibility is the opposite of optimal aircraft utilization. A commercial airline optimizes utilization by flying predetermined routes on fixed schedules. Full planes reduce per seat costs. A charter company optimizes utilization by maximizing flight hours. But maximizing flight hours while accommodating customer flexibility is structurally contradictory. You're either flying in profitable routes to serve customers or you're turning away revenue to wait for optimal routes. You're either flying with empty seats to meet customer requests or you're making customers wait. There is no perfect solution. Every flight is a compromise between revenue maximization and customer accommodation. This is the fundamental tension that separates successful charter operations from those that lose money year after year. The full upfront investment, what actually costs money. Everyone talks about the aircraft purchase price. Nobody talks about everything else that makes the aircraft operational and profitable. The aircraft, $3 million to $80 million. A light jet like a Learjet 75 costs $15 million to $25 million. A mid-sized jet like a Citation X costs $25 million to $35 million. A large cabin jet like a Gulfstream G650 costs $65 million to $80 million. Used aircraft are cheaper. A pre-owned Learjet from 5 years ago costs $8 million to $12 million. But used aircraft come with unknown maintenance histories and potential issues. Most charter companies finance jets through specialized aircraft financing. A $20 million jet financed at 5% over 20 years is $132,000 per month, or $1.584 million per year in debt service. Crew staffing, pilots and flight attendants. A charter operation needs at minimum 2 pilots and 1 flight attendant per aircraft. Experienced pilots for charter operations earn $150,000 to $250,000 per year. Flight attendants earn $60,000 to $100,000 per year. That's $370,000 to $550,000 per year in direct crew salary before benefits, taxes, and training. A charter operation with 5 aircraft needs a crew structure that covers all aircraft simultaneously, which means you need 8 to 10 pilots and 4 to 6 flight attendants. That's $4 million to $6 million per year in crew costs. This is fixed regardless of how many charters you actually book. Hangar space and facility. $500,000 to $3 million initial, $50,000 to $150,000 per year. Charter jets need protected hangar space. They can't sit on the tarmac. Hangar space at major airports costs $40,000 to $150,000 per month depending on location and aircraft size. You also need maintenance facilities. You need a crew-ready room. You need customer waiting areas. Building out or leasing these facilities costs significant capital. A single aircraft hangar lease at a major airport is $60,000 to $150,000 per year. Maintenance and inspections, $300,000 to $1 million per year. Private jets require mandatory inspections and maintenance. Annual inspections. Condition inspections. Parts replacement. Engine overhauls cost $200,000 to $500,000 per engine. A Gulfstream has 2 engines. A major inspection can cost $50,000 to $150,000. Heavy maintenance is mandated on schedule. A jet doing 500 charter hours per year incurs predictable maintenance costs. Most operators budget $2,000 to $4,000 per charter hour for all maintenance combined. Fuel, 35% to 50% of charter revenue. This is the largest variable cost. A light jet burns 500 to 600 gallons per hour. Jet fuel costs $3 to $5 per gallon. A 4-hour light jet charter burns roughly 2,200 gallons at a cost of $6,600 to $11,000 in fuel. If that charter generates $32,000 to $48,000 in revenue, fuel is 20% to 35% of revenue. A large cabin jet burns 1,000 to 1,200 gallons per hour. A 4-hour large cabin charter burns 4,500 to 4,800 gallons at a cost of $13,500 to $24,000 in fuel. If that charter generates $60,000 to $80,000 in revenue, fuel is 17% to 40% of revenue depending on fuel prices and pricing. Insurance, $100,000 to $300,000 per year per aircraft hull insurance. Liability insurance. Passenger injury insurance. A charter operation has significant insurance liability. Accidents are rare but catastrophic. Insurance companies charge accordingly. Large charter companies with multiple aircraft might reduce per aircraft costs, but still pay millions annually in insurance. Landing fees and handling, $2,000 to $10,000 per flight. Every landing incurs fees. Tarmac fees. Handling fees at the destination. Parking fees. Catering charges. De-icing if weather requires. These fees are typically passed to customers, but they eat into margin if pricing doesn't account for them properly. Pilot training and certification, $50,000 to $150,000 per pilot annually. Charter pilots need continuous training. Simulator training. Type rating renewals. Recurrent training. This is mandatory and expensive. Charter network software and reservations, $50,000 to $200,000 per year. You need a system to manage bookings. A website. Customer relationship management. Real-time availability tracking. Software as a service subscriptions. This is essential infrastructure. Marketing and customer acquisition, $200,000 to $1 million per year. Getting customers to book charters requires consistent marketing. Trade shows. Digital marketing. Broker relationships. Sales staff. A charter company operating 5 aircraft might spend $400,000 to $800,000 annually on customer acquisition. The real total investment, for a single aircraft charter operation, the total upfront investment is $20 million to $30 million including the aircraft, crew, facilities, and working capital. For a 5 aircraft charter operation, you're looking at $120 million to $200 million in total capital deployment. Most charter companies don't own aircraft outright. They finance heavily. If you finance $20 million at 5% over 20 years, that's $1.584 million per year in debt service. Before you book a single charter. Where the money actually goes, the operating cost reality. Once you own the aircraft and you're operating charters, the costs don't pause. They're relentless. And this is where the math turns against most charter operators. Monthly operating cost for a single light jet, $20 million aircraft. Assume the aircraft operates 300 charter hours per year, roughly 25 hours per month. This is approximately 6 to 8 charters per month, which is a realistic volume for a well-managed light jet. Revenue per flight hour, $5,000, average across all charter types. Monthly flight hours, 25 hours. Gross monthly revenue, $125,000. Direct operating costs, fuel, 40% of revenue. $50,000 crew salary, allocated $30,000 maintenance reserve, $2,500 per hour. $62,500 landing and handling fees, $5,000 hangar rental, $12,000 insurance, allocated $8,000 total direct costs, $167,500 operating loss before debt service, $42,500, annual operating loss, $510,000. Debt service monthly $132,000 total. Monthly loss $174,500, annual total loss $2.094 million. Wait. This aircraft is losing $2.1 million per year despite operating 300 hours annually and generating $1.5 million in gross charter revenue. This is the reality that most single aircraft charter owners don't face until it's too late. What charter operators don't account for: the utilization trap. The math above assumes 25 flight hours per month. This requires the aircraft to be booked for 5 to 6 charters monthly. In reality, utilization is lower. Seasonal fluctuations. Winter holidays are peak booking season. Summer is slower. The aircraft that books 5 charters per week in December books 2 charters per week in July. Your fixed costs don't decrease in summer. Crew still needs to be paid. Hangar rent is still due. Insurance is still due. Revenue drops 50% to 60% in slow months. You're now losing substantial money monthly. Empty leg positioning. A customer books a charter from New York to Miami. The aircraft needs to reposition from wherever it was previously to New York first. That's an empty leg. The aircraft burning fuel, using crew, incurring costs, generating zero revenue. Operators try to sell empty legs at heavy discounts to fill unused capacity. But discounted empty leg flights are lower margin and require active marketing and operational flexibility. Turnaround time between flights. A charter lands in Miami. The next customer doesn't need pickup until 4 hours later. The aircraft, crew, and facilities must be available. The crew must rest. Maintenance must be performed. You can't book back-to-back consecutive flights because regulatory rest requirements and maintenance windows prevent it. This dead time represents aircraft capacity that generates zero revenue. Weather and mechanical delays. Storms ground aircraft. Mechanical issues require time and maintenance. The aircraft is down for a day and you lose multiple potential charters. You can't predict this. You can't build it into utilization models reliably. It just happens and margin disappears. Customer cancellations. A customer books a charter weeks in advance. A week before they cancel. You've been holding that time slot. You've blocked other potential bookings. Now you have an empty aircraft and no revenue. Cancellation policies help. But they don't eliminate the impact entirely. Real charter operator profitability. The truth nobody discusses. The industry standard expectation is that a charter aircraft needs to generate 600 to 800 flight hours per year to be truly profitable after all costs. A light jet at 600 hours per year at $5,000 per hour is $3 million in annual revenue. Operating costs of 70% to 75% of revenue are $2.10 to $2.25 million. Debt service on a $20 million aircraft is $1.584 million annually. You're losing money even at high utilization. This is why most successful charter operations don't own aircraft. They operate on behalf of owners or they partner with large aircraft management companies that spread fixed costs across multiple aircraft and multiple owners. The reality by operation size: single aircraft owner-operator hours per year, 300 to 400 revenue per year, $1.5 million to $2 million operating costs, $1.2 million to $1.5 million, 60% to 75% of revenue, debt service, $1.2 million to $1.6 million annual result. Losing $900,000 to $1.3 million unsustainable without outside income. Small charter company, 3 aircraft, hours per year, 1,200 to 1,800, averaging 400 to 600 per aircraft, revenue per year, $6 million to $9 million operating costs, $4.20 million to $6.75 million, 70% average, debt service, $4.752 million to $7.92 million annual result, losing $2.95 million to $5.67 million, only profitable if financed very conservatively or if aircraft are owned outright. Large charter company, 10 plus aircraft, hours per year, 5,000 plus, 500 plus per aircraft, revenue per year, $25 million to $40 million operating costs, $17.5 million to $28 million, 70% average, debt service, $12 million to $16 million annual result. Losing $4.5 million to $4 million scale improves margins but doesn't eliminate the fundamental challenge, the brutal reality. Most charter aircraft operate at a loss. They're financed as capital appreciation plays, not operational profit plays. Owners expect the aircraft to appreciate in value over time. They expect operational losses to be offset by asset appreciation. They expect eventual sale at a premium. This works until aircraft values stop appreciating. Then the economics collapse. While location and customer concentration matter enormously, a charter aircraft based in New York near Manhattan can serve wealthy individuals and corporations. It can do 3 to 4 charters per week reliably. An identical aircraft based in a secondary market with lower demand averages 1 charter per week. Same aircraft. Same costs. 75% lower revenue. The difference between profit and catastrophic loss. Charter operations thrive near concentration of wealth. New York, Los Angeles, Miami, San Francisco, London, Dubai. These markets have enough high net worth individuals and corporate demand to support meaningful utilization. Secondary markets don't. A charter operator starting in a secondary market is fighting against geography. The hidden advantage of aircraft management companies. This is where the economics get interesting. Companies like NetJets and Flexjet don't primarily make money owning aircraft. They make money managing aircraft on behalf of owners. They charge 7% to 10% of charter revenue plus management fees. They aggregate demand across hundreds of aircraft. They optimize positioning. They have scale in crew training, maintenance negotiation, and regulatory compliance. They turn the unprofitable single aircraft model into a profitable service business. A small aircraft owner partnering with a management company sacrifices some margin but dramatically improves utilization and cash flow. The management company generates revenue per aircraft without owning the aircraft. It's a different business model entirely. The good scenario: when charter operations work, you partner with a management company to operate your $25 million Gulfstream. You don't finance it. You own it outright. The management company secures 500 charter hours per year at an average rate of $8,000 per flight hour. Gross revenue, $4 million per year. The management company takes 8% as their fee. You receive $3.68 million. Operating costs including crew, fuel, maintenance, insurance, and facilities total $2.7 million. You net $980,000 per year in cash flow. Not a return on $25 million capital, but it's something. You're banking on the aircraft appreciating at 2% to 3% per year, which would add another $500,000 to $750,000 in annual appreciation. Total annual return, $1.48 million to $1.73 million on $25 million capital, or 5.9% to 6.9%. You're making a reasonable return. The bad scenario. The more common outcome: you buy a $20 million Gulfstream with $15 million in financing. You try to operate it independently. You don't have the customer relationships to secure consistent bookings. You're relying on aircraft brokers to find customers. Average utilization is 300 hours per year. Revenue is $1.5 million. Operating costs are $1.2 million, 80% of revenue because fixed costs are spread across fewer hours. Debt service is $1.584 million. You're losing $1.284 million annually. You can sustain this for maybe 2 years before you're forced to sell. You sell the aircraft for $18 million after depreciation. You've lost $3.5 million in equity plus $2.6 million in accumulated losses. Total damage, $6.1 million over 2 years. You've learned that operating a charter company independently is financially destructive. The illusion of empty leg arbitrage. New charter entrepreneurs often fantasize about buying used aircraft at discounts, selling empty legs at near market rates, and arbitraging the margin. The math seems brilliant on a spreadsheet. A $10 million used jet. Operating costs of $1.5 million per year. Generate $2 million in charter revenue. You're profitable. The reality is that empty leg pricing is 30% to 50% lower than standard charter pricing. An empty leg that would normally generate $5,000 per hour now generates $2,000 to $3,500 per hour. You can't build a profitable operation on empty leg revenue alone. You need full-price charter bookings. And those bookings require either customer relationships that take years to build or partnership with a management company that takes 8% to 10% of revenue. Conclusion. The actual economics of jet charter ownership. Owning a private jet charter company is not a passive income business. It's a capital-intensive operational business with massive fixed costs, unpredictable demand, and structural challenges to profitability. The money in jet charter goes to 4 groups. First, aircraft manufacturers capturing margin on sales. Second, management companies capturing fees on utilization. Third, charter operators who've built strong customer relationships and high utilization. Fourth, owners using charter partnerships who benefit from appreciation plus moderate cash flow. The separation between operators who make money and those who lose it comes down to utilization, customer concentration, and capital structure. An aircraft financed heavily at high interest rates needs 600 plus hours per year to break even. An aircraft owned outright can tolerate lower utilization and still generate cash flow. An aircraft operating in a major wealth center can secure higher utilization than an aircraft in a secondary market. But here's what almost nobody discusses openly. The jet charter business is winner take most. The large established operators like NetJets and Flexjet have customer relationships, scale, and pricing power. A new entrant starting with 1 or 2 aircraft has none of these advantages. You're competing against well-capitalized incumbents with massive networks. The gap between success and failure is enormous. Most single-aircraft operators lose money. Most 3-aircraft companies lose money. Only large integrated operations with 20-plus aircraft and strong management can generate consistent profits. A private jet charter company is fundamentally a capital appreciation play, not an operational cash flow play. You buy the aircraft hoping it appreciates 2% to 3% annually. You operate it to offset some of the carrying costs. If appreciation happens, you make money. If appreciation doesn't happen, you lose money. This is a different investment thesis entirely from building a profitable business. And if you're not clear on which thesis you're pursuing, you'll be underwater quickly on an asset that costs millions to own.